Hey, thanks, Sandy, and hello, everybody. We're here today to talk about rulemaking that the Consumer Financial Protection Bureau came out with on January 7th of 2013 to implement Dodd-Frank provisions relating to mortgage servicing. In particular, we're going to talk today about changes to Regulation X, the regulation that implements RESPA, that pertain to servicing requirements. At the same time that the CFPB came out with the amendments to Regulation X on servicing, they also amended Reg Z to address servicing changes over there. The Reg Z servicing changes were discussed in a prior webinar, so today is Reg X all the time. So we're going to begin by laying the groundwork by talking about the type of loans that are covered by the new servicing requirements, and then we'll get into the small servicer exemption. Now, the first thing you need to know about that is that even if you qualify as a small servicer, that doesn't mean that you're exempt from all of the servicing changes. In fact, most of them will, as we'll discuss them, you'll see that they really reflect best practices. So even if you find yourself exempt from some of them, they are something that you should look at and consider. Jack and I were talking about this morning, and we talked about the fact that now examiners are going in and they're saying, yes, we know, for example, that the Fair Debt Collection Practices Act doesn't apply to your institution when it's collecting debts owed to your institution in your own name, but we believe that that law sets a standard that you should try to adhere to. So keep that in mind as we discuss some of these things. And on some of the requirements, you're going to find that it's not a complete exemption even if you are a small servicer. It just allows you to take an alternative approach. One of the big changes here has to do with the force-placed insurance and how you are going to handle that. So we're going to talk about mortgage servicing transfer requirements. We're going to talk about timely payments for escrow accounts. We'll cover what you will now have to do before you can force-place hazard insurance. We'll talk about how you will need to respond to information requests from the borrower and error claims from borrowers. Plus, we'll get into new requirements for policies and procedures on servicing, and we'll go through the rules for loss mitigation procedures. As you see on page 2, the rule is from the Consumer Financial Protection Bureau, and they have information about it on their website. They've started doing videos that are really just narrated PowerPoint slides, but they're good for an upper-level view. They don't get into a lot of detail, so they don't substitute for reading the reg and attending programs such as this. And the Small Entity Compliance Guide is also good for just a quick reminder of how things work. Over on page 3, as I mentioned previously, the rules that we're going to discuss today implement provisions added to the Real Estate Settlement Procedures Act by Dodd-Frank. Originally, RESPA was under the purview of HUD. It was transferred to the Consumer Financial Protection Bureau in 2011, and that meant that Reg X went from being a HUD reg to a CFPB reg. So now it's at 12 CFR 1024. In terms of official guidance, I'm sure you recall when the rule was under HUD and they tried to kind of skirt the official guidance and issue informal things such as the RESPA roundup. Well, you've got the reg itself, and now we have official commentary. If you look through the official commentary, and you will find it on our alphabet soup section under Reg X, it's at the bottom of each of the sections. If there's official commentary issued for that section, it's right there. You'll see that compared to Reg Z, it's pretty short and pretty sparse, but hallelujah that we have it at all, because it makes your job much easier in terms of researching, and I have no doubt whatsoever that that commentary will be beefed up considerably in coming years. As you know, the purpose of RESPA and Reg X is to help customers understand the costs that are associated with their dwelling secured loans. And traditionally, that's been done through the use of the good faith estimate, the HUD 1, the HUD 1A settlement statement, and escrow account statements. When we get the integrated mortgage loan disclosures, there will be some changes there, but for right now, we're still dealing with the GFE, the HUD 1A, and so forth. The other major thrust of RESPA and Reg X is the prohibition against kickbacks, referral fees, and excessive escrow balances. So they're trying to stop artificial inflation of settlement service cost, and trying to make sure that the escrow balances that consumers have are enough to cover disbursements for taxes and insurance, but don't have a whole lot of excessive padding. So I'm going to quickly go through the coverage rules here. This is going to be very familiar to you over on page 4. RESPA applies to federally related mortgage loans, except for those that are exempt. What is a federally related mortgage loan? Well, it's a loan other than temporary financing, like a construction loan, that has any kind of lien on real property upon which there is located or will be located within a period of time a 1 to 4 family dwelling. And in terms of if it will be located, we'll see in just a minute that it has to be located within 2 years using the proceeds of the loan. In terms of who is covered as a lender, well, let's just skip through that on the bottom of page 4 and page 5, because if you are listening to this webinar, you already know that you're covered as a lender. In terms of a quick review of the important exemptions from coverage, over on page 6, you know that there are 7 exemptions from RESPA coverage. Some of them come into play more often than others. If the loan consists of if the collateral for the loan consists of property of 25 acres or more, it's exempt, as are business purpose loans. The Reg X points to the Reg Z business purpose test. So if a loan is considered to be a business purpose loan under the complex rules in Reg Z that you encounter, and I say complex just because sometimes when you have something where it's maybe property that the person is going to be renting out some of it, maybe living in some of it, you've got more detail. Well, that's where you look, is in Reg Z. Temporary financing, like a construction loan, can be exempt, but don't forget that you've got the clause in there that says that you aren't exempt if that temporary financing is set up in such a way where the loan's used as or may be converted to permanent financing by the same lender. Plus, if the loan proceeds are used to transfer title to the first user, then you also lose that exemption for temporary financing. Vacant land loans are exempt unless within 2 years of making the loan using the proceeds of the loan, a dwelling is going to be constructed or placed on the property. You've got an exemption for assumptions without lender approval, and I guess my comment on that is not going to happen, people. I don't know of anybody who allows some third party to assume their borrower's loan without being able to say, yeah, as the lender, you are acceptable to us. We'll approve it. Loan conversions are in the exemption. So, for example, if you're converting a variable rate loan to a fixed rate